Hi everyone, welcome back to the channel. Today we're diving into a timeless debate that has puzzled investors for decades. Gold versus stocks. Which is the better investment? We will surely find out. If you had invested $10,000 in each 50 years ago, which one would have made you richer today? And more importantly, which one should you be putting your money into right now? But first, let's take our time machine back to the year 1975. Welcome to the year 1975. There is so much happening. The Vietnam War finally ended. Boxing is on the rise, dominated by the great Muhammad Ali. Tech enthusiasts working on early personal computers, their effort led to the formation of one of the biggest tech companies of the future, Microsoft. In my excitement, I got carried away. Let's get back to our topic. You have $10,000 and two choices: buy gold or invest in the stock market. Gold in 1975 was priced at around $160 per ounce. $10,000 would get you 62.5 ounces. S&P 500 in 1975 was around 90 points, and $10,000 invested in a S&P 500 fund, including reinvested dividends, would buy you shares that grew over time. Gold today in the year 2025 is priced around $2,900 per ounce. Your 62.5 ounces are now worth about $182,000. S&P 500 with dividends reinvested would have given an average market return of 10% for each year since 1975. Today, in the year 2025, your initial investment of $10,000 in S&P 500 would have turned into a whopping $2.5 million. The numbers don't lie. Stocks have completely outperformed gold in the long run. This historical analysis shows that it is compulsory to have stocks in an investor's portfolio for the long term, to get exponential returns. But before you dismiss gold, there's more to the story. Gold shines the brightest when things get ugly. During the 2008 financial crisis, while the stock market crashed 50%, gold rose by nearly 25%. In 2020, when COVID-19 rattled the markets, gold hit an all-time high while stocks plummeted. In high inflation periods, gold has historically held its value better than cash or bonds. Gold is a hedge. It protects your wealth during economic chaos, but it doesn't create wealth the way stocks do over the long term. Stocks, on the other hand, thrive when the economy is growing. Between 1980 and 2000, gold went nowhere while stocks soared. Companies pay dividends, expand, and innovate, creating exponential growth over time. Historically, stocks recover from crashes, while gold's performance can be unpredictable. While gold is great for protection, stocks are unbeatable for building long-term wealth. Now, here's the big question. How much of each should you have in your portfolio? For long-term investors, 80% to 90% in stocks for growth, and 10% to 20% in gold as a hedge. Time and compounding will give long-term investors exponential growth in the stock market. For risk-averse investors or retirees, 40% to 50% in stocks and 40% to 50% in gold and bonds. This gives them protection even if the stock market crashes. Remember that gold is like insurance. You don't buy it to get rich, but to protect what you have. Stocks, on the other hand, are the wealth-building machine. The more time you give this machine to operate, the higher the returns it will return. So, what's the verdict? If you want long-term growth, stocks are the way to go. If you want safety during uncertain times, gold is your hedge. A smart investor should hold both. You can never guarantee where the market is heading. As they say, better safe than sorry. What's your portfolio mix? Let us know in the comments. And if you found this video informative, hit that like button, share with family and friends, and don't forget to subscribe for more investing insights. See you in the next one. Goodbye.